Hello friends, this is Mayank and welcome back to the Investment Mantra series where we learn how to do our financial planning. So if you remember in last video we have seen how to create our financial goals. We have also seen how we can calculate the amount that one needs to save to reach to those goals. So today we are going to see what are the different options available for us so that we can invest our savings and reach to our goal. So we are going to see and understand what are the different asset classes, what are the risks involved, and how much return we can expect from those asset classes. So with that, let's start our course one, that is the basics of financial planning, and in that we are seeing understanding different asset classes. So we have broadly speaking five major asset classes that we can invest in. The first one is fixed income or the debt. So this includes bank FDs, bonds, debt mutual funds, etc. Second asset class where one can invest are equities. So equities includes stocks or the mutual funds. So equity oriented mutual funds which buys different company stocks on behalf of individuals. The third asset class is real estate where one can go for residential property or commercial plots. Then there are these financial instruments through which we can invest in real estates. They are known as REITs, InvITs. The fourth asset class is gold, where you can buy physical gold or you can invest through gold ETFs. We'll see in detail like what are the options we have. Then the last one is cash and cash equivalents. So these are like we can keep cash with us or we can invest in liquid mutual funds. So these are broadly five asset classes which we can use to invest our money. Now let's see like each asset class in detail. So let's first start with fixed income or the debt. So what are the different options that we have in fixed income? So the number one, like everybody knows about it, saving bank account. We can keep our money in our saving bank account and we can expect to get somewhere between 4 to 6% of return. And the risk is low. Like there is relatively considering all the options, very low risk of losing our money. So it's almost guaranteed that we will get 4 to 6% return if we keep our money in saving bank account. Second option is we can open a fixed deposit with our bank. So basically we can lend money to bank so that they can lend to somebody else, and in return we will get a fixed percentage that varies from 6 to 8. And again the risk is low because the banks are normally have backing from government and they have rules and regulations from the RBI. So there is a very little chance that a bank will default. So bank deposits are considered safe, but the return that we can expect from them is 6 to 8%. Then we can go for government bonds. Like from time to time, government of India or the state government issues bond, and we can purchase those bonds, and we can get somewhere between 6 to 8%. Again, as these bonds are sovereign in nature, the risk is low. The losing, like we will not lose our money, and return is also almost guaranteed. The third option is companies deposits, or sometimes they call it NCDs, that is non-convertible debentures. So basically what company does is like they want some money. So they want to take our money and in return they want to give us certain fixed interest. So here the difference is we are giving money to company and in return we are earning interest. But the risk profile for this NCDs are high. And why that is high? Because let's say if you give some money to a company and because of some circumstances the company is not profitable or it's not able to return the principal that we have paid, then our money is at risk. So here the risk of losing our principal is high. The fourth option is small saving schemes. So these are again the government schemes like national saving certificates, or we have the public provident fund, PPF. So here again the risk is negligible and we can expect somewhere between 8 to 9% of return. Then there is one more category. There are mutual funds. So these are mutual funds. So we have seen like the company deposits or the NCDs and the government bonds. So what this mutual fund does is they buy all this. Like they buy government bonds, they buy company deposits from multiple companies, and then they make a portfolio out of them. So what this mutual fund will do is they will purchase only the debt instruments, and on behalf of you yourself you can invest in those mutual funds, and then you can expect a return from somewhere 6 to 12%. So risk profile here is moderate because they are not investing in one particular company. So they have a portfolio of multiple companies plus bonds which are related with government. So the risk profile here is moderate, but it's not negligible because there are some companies involved, and because of which you can lose your some portion of your money. Then there are insurance product who invest in the debt instruments and provides you insurance. So we call them ULIPs. But normally we should not use instruments which are used for insurance for our investment purpose because the return is less in those instruments. And as you can see, you will get only 3 to 6% with a moderate risk profile. So basically these are the options that one can go for if he is looking for a fixed income. So he will broadly, if you see, he will get from somewhere from 3 to 12%. That's the amount that one can expect to get from fixed instruments. So next asset class is equities. So in equities, what we do is we buy, instead of like giving money to someone and getting interest. Here we buy a piece of business. So we become the owner. So the first option is we can directly go into the stock market and we can purchase the stocks or the shares of the company. Like you can go to the market and you can buy the shares of Apple, or you can go and buy the shares of Infosys. So you will become the part owner of that particular company. But if you see the return here, it ranges from minus negative 100% to 100% if we consider a year. Because like let's say if you go to the market and you bought a share in 400 rupees, but that company stock can go from 400 to 0 or from 400 to 800. So here the risk is very high. And on an average, like if you keep it for a longer term, you will get somewhere between 10 to 20% per year. So that's the average return that you get. You can get more than 20% also. But on an average, you can expect somewhere between 10 to 20% from company stocks. So it can vary drastically depending upon like which company you have chosen. So the returns are high, but the risk profile is again high. The second option is equity mutual funds. So again, so instead of buying a single company stock, what these funds do is they buy multiple companies and they create a portfolio so that it helps in diversification. So it reduces the risk a bit, but again, depending on the market, there is still a risk. So the average return varies from minus 30% to 30% in a year. So with these returns we are talking about in a year. So you should be prepared that if you are investing in this instrument, your principal can come down by that percent. But on an average, you will get again 10 to 20% of return in a long run if you invest through equity mutual fund. Equity mutual funds. Then there are these equity related exchange traded funds. So these are similar to mutual funds, but what we do in ETFs are like we have certain stocks, we create a portfolio, and then we put that particular portfolio itself for trading on stock exchange. So for now, you can just understand that those are similar to equity mutual funds, but again, the risk is same as those of equity mutual funds, and the returns are also same. But the risk profile we have to categorize whatever is related to equities as high, because here you have the risk of losing your principal. So you have to be very careful, and you should be prepared to study these things first before you start investing in equities. The last one is the ULIP. Again, these are the insurance related product, and the risk is same, but the average return is very less, like 3 to 10%, because you have to buy insurance along with this, and which impacts our return. So again, as I mentioned earlier, you should not go for ULIPs if your purpose is to get higher returns. So these are the options through which we can invest in equities. The third asset class is real estate. So in real estate, like most of us are familiar. So in real estate, when we say real estate, we can go and buy a residential house. Here we get a return somewhere from negative 10% to 20% depending on the market. But on an average, we'll get 8 to 10% return in real estate. because we get property appreciation. Along with that, we can expect some return in rent. So here the risk profile is medium. We can also go for commercial shop, showroom, office spaces. So here again the return is similar to residential house, but on a higher side. Like we can expect up to 30% return, and on an average we get 10 to 15% because these are related to business. So the rental yield is also more in commercial properties. The third important instrument through which we can invest in real estate are REITs and InvITs. So as we have seen the equity mutual funds or the debt mutual funds, where a fund manager on our behalf invests into the shares or into the debt instrument. Similarly, here we have REITs, where there will be a fund manager or there will be a company who will buy the real estate on your behalf. So they will pull the money from different investors, and then they will buy the real estate, and the rental yield that they will get from that commercial property or the residential property, that will be given to the investors through dividends. So right now in India we don't have REITs, but in Europe and in US we have a lot of REITs and a lot of type of REITs available. So in future videos we will see like how exactly these REITs work. But for now you should understand that we have this instrument which work like a pooled fund, and that fund will go into the real estate. The fourth option is you can buy a plot or land. Again the average return is 10 to 10% somewhere in the range, but you can get up to 30% depending on the area and the locality. So this is about the real estate and how you can invest in this particular asset class. It's a very important asset class, and in our coming videos we will learn more about these things. Then the next asset class is gold. So in gold you can buy physical gold in form of jewelry, biscuits, coins, and you can expect somewhere between 2 to 8% return, and the risk profile is medium. Also, you can go for gold ETFs where you need not buy the physical gold, but you can buy the ETF, which is linked with the price of gold. So you will get the similar return depending on the price fluctuation of a gold, but you need not hold or store that gold yourself. So it will be in the form of demat. Like you can store that in a demat account. Then there is gold fund of funds, so which is similar to mutual funds, but they invest in gold ETFs. So the only difference in gold fund of funds is that you don't need a demat account to keep gold fund of funds. But in case of gold ETF, you need to have a demat account. We will see in future like how exactly we need to purchase these ETFs or fund of funds. But as of now, you should understand there are broadly these three instruments through which you can invest in gold as an asset class. Now, another asset class is cash or cash equivalent. So as we all know, we can always keep cash, but we cannot expect any return on that, or we should say that we should expect a negative return on that because of inflation. So if 7% is the inflation, and you have 100 rupees with you in cash, next year its value will be 93 rupees, 7% less, because you can buy what you can buy from 100 rupees today, you will not be able to buy the same thing after 1 year. Then there are certain liquid mutual funds which are considered as cash, like you can just put your money into those, and whenever you want you can take that money out. Ideally the saving bank accounts also fall into this category, this cash and cash equivalents, because you anytime you can go and take the money out. So it's the cash available to you. So as you can see, the return is very less, 3 to 6%. Risk is again low because these are very short term instruments. But this is again a category of asset, so not an ideal one to get good returns, but for our day-to-day needs we need to have some cash also. So friends, we have seen today like what are the different asset classes. So broadly we have five. Just to summarize: fixed income, equities where we can expect more return, real estate, average return, gold, and cash equivalents. So you should understand like these are the five major asset classes through which we can create our portfolio and reach our goals. In the coming videos we will see like how to do the asset allocation. So now we have seen like there are the different asset classes. So how to distribute our savings into different asset classes so that we can minimize risk and maximize our return. That's our goal, right? Like to get as much return as we can, but we want to reduce our risk. We don't want to lose our money. So with that, I hope you like this video. Please comment, like, and share, and let me know if you want me to cover any specific topic related to this. And I will see you next in the coming videos. Thank you.